Yeah, thanks, Matthias, for hosting us here. Always glad to be back at the International Investment Forum. We've updated our presentation for October here, so it's a bit of a new unveiling. We've added a nice accolade on the report on business from the Globe and Mail newspaper here in Canada. We are ranked as the 18th fastest growing company in Canada this year. It was based on a 3-year revenue growth, and that puts us as the fastest growing oil and gas producer in Canada as well. So it's we've been on a breakneck kind of path here, growing quite nicely through the drill bit, as well as through some acquisitions. So I'll happily walk you guys through our recent growth. So when I joined the company, again, just a couple of short years ago, in the start of 2021, the company was doing 200 barrels a day. In the second quarter, we hit 26,000 barrels of oil equivalent per day of production. And really, we've gone through some acquisitions, like I said, great drilling programs, and it's been adding oil and gas production to the point where we're kind of switching gears right now from growth mode to harvest mode. Really, at this point in time, with the high oil prices and our sustainable production, we are churning out quite a bit of cash flow. And right now, we're set now at maximizing our free cash flow of what we've already built in-house. So 26,300 plus or minus BOE a day is our target for the upcoming next couple of quarters. We have that'd be generating somewhere about $375 million of EBITDA for this year. Well, $2.25 is where we're getting to in terms of cash flow per share. And the big part that we're focused on is sustainability and making sure that we have the inventory in-house to keep this production level for the upcoming foreseeable years and decades. And so we have right now about 15 years of inventory on hand at our current drilling pace. We keep production stable for some time to come. We're still fresh off the acquisition of Ridgeback Resources. It was a big step up for us, increased our production by 140%. We added 17,000 BOE a day of predominantly light oil production. It was about a 71% mix towards liquids. We paid $525 million for acquisition, so pretty inexpensive considering that private company was churning out on an annualized basis north of $300 million of cash flow. So we acquired it for a relatively low multiple, less than 2 times cash flow. And of course, that brought in some large shareholders. Of course, GMT Capital, new to our company as a shareholder, backstopped the offering of up to $60 million of investment, and they've continued to acquire our name in the aftermarket. They're just about 25% ownership of our company now. It's GMT Capital it's a family office out of Atlanta, Georgia. A big supporter of ours, and sees the vision of what we've put together here in terms of maximizing this free cash flow. So currently, we have brought on a little bit of acquisition debt with some of these acquisitions we've made. We're paying down that debt as quick as possible. It's at a pretty steep decline in terms of we think we can have all of our debt paid out if we continue to pay it all down by sometime in early 2026. And really, that's a factor that 60% of our cash flow gets directed towards debt repayment. And that's a pretty important goal of us, is to de-lever this company and really at the same time maintain the production level where it's at and the cash flow generation ability of it. So looking at our capitalization, we're roughly about 140 million shares outstanding. That's put us about between 350 and 400 million Canadian dollar market cap. And like I said, we're carrying a debt balance that's just about 500 million. And the idea is, as we pay down this debt, get it closer to 450 million by year end, and then by middle of next year we'll be down, targeting somewhere around 300 million dollars. And at that time, we expect to maintain the production, maintain the cash flow, and expect that there might be a backfill on the equity value. So decrease the debt, and that's another dollar towards, I think, equity value for our shareholders. So we've put together a bit of a track record here. Certainly in terms of growth, we're enjoying the high price of oil. It's certainly driving our revenues to very strong positions. But what's also most important to us too is not how much money you get for the barrel of oil, but how much you keep of that barrel. And so we've been trimming our operating costs. In 2021, we were close to $28 Canadian per BOE as an operating cost, and we've got that down to just around $22.50 here in the first half of 2023. So we're seeing a 20% decrease in our cost structure. Our royalties have also gone down from 15% down to just over 10%. And it's a factor of bringing on new wells that we've drilled that often come with a royalty holiday. And so we're lowering the amount that we still pay quite a bit to the government, and happy to do so for our royalties, but that is coming down off each barrel. So what that does is it drives our netbacks even higher. So even in a time when commodity prices have been falling, we still maintain a very strong netback. One of the strongest netbacks in the Canadian oil patch. For every dollar, for every barrel of oil that we produce, including natural gas in the mix, in the first half of this year, we're seeing about $44.50 of cash flow after our hedging program for every barrel we're doing, and that's just gone up year over year, and we continue to look forward to that going up in the second half of the year as we're enjoying some higher oil prices than the first half. So the oil business right now is about creating cash flow. We're not talking about what big projects that are ahead of us that are going to increase our revenues going forward. Right now, we're at in the second quarter of this year, we put up about $95 million of EBITDA. We had some fires here in Western Canada, curtailed some production, actually put some of our employees out of their homes for a certain time, but everybody's back safe and back in their homes and back at work. So we lost a little bit of production in Q2. So we expect that Q3 and Q4 will be again ticks up on the EBITDA side. I think probably in Q2 we would have done over $100 million EBITDA. And that's probably something, a mark that we would look to do, is eclipsing $100 million of EBITDA every quarter going forward. So quite a bit of cash flow coming at us. We've got 4 core areas now. We've expanded this year into Alberta. We're also in the province of Saskatchewan, where roughly 60% of our production is coming from. And on that side of things, they're all focused on light oil. We have 950 drilling locations that have been booked by Ryder Scott, our third-party reserve auditor. So they've looked at the geology, the well placements around there, and have come back and opined that those are good locations, and they've granted us reserves on those locations. So that's going to keep us busy for the next 15 years. And we have a large number of reserves in place too, over 150 million BOE of 2P reserves. So that's makes us have a pretty long reserve life index in terms of sustainability. We want to be able to keep this production at this level from internal purposes, for many, many years, and enjoy that cash flow and certainly to pay down that debt going forward. Touch briefly on our biggest asset. This is the Oxbow asset. We increased our production here by roughly 70% with the acquisition of Ridgeback Resources. The eastern portion here, it's labeled Viewfield on the map here, was really contiguous to everything that we were doing in southeast Saskatchewan. We really are the kind of the big fish in the small pool here, where this tiny little corner of Saskatchewan. We've consolidated most of the oil production in this area, and making an acquisition of Ridgeback Resources with this large Viewfield pool was a natural strategic extension of our area in here. And in fact, that's where we're drilling right now. We're drilling Frobisher light oil wells, long horizontals on this new land that we acquired from Ridgeback. Roughly about 580 booked locations we have in this area. We have a few hundred more on top of it of our own ideas, but so far Ryder Scott has rounded up about 580 of them for reserve purposes. So it's about 60% of where our locations are, and this is a big cash cow and an area we expect to be developing for a long time to come. We have over 4,000 kilometers of underground pipeline network in this area, and it's absolutely critical to have that infrastructure to be able to control this area and lower the operating costs and basically get that oil to market at the cheapest price possible. We put out some news just a couple weeks ago. We finished up our spearfish drilling program. Now this is a new horizontal area that we've been developing, and it's new to us. We've been drilling mostly Frobishers and other Mississippian age oil deposits. In this case, we had 6 wells, and they came on at phenomenal rates, well above our expectations in terms of our type curve for this. And what's nice about this formation is that we expect it to be very long-lived production because there's very low decline. In fact, you kind of see the production plots for the first 30 days of these wells, and basically they've gone somewhat sideways or even trending up over time a little bit. Now, we can't expect that going forward for the full length of the life of these wells, but certainly something that these are great wells, great addition to our production base, all light oil and receiving very strong netbacks right now. So it was a real win for our geology and engineering group to put this program together. And we have probably over 35 locations in this area that we've got on the books. So we'll be back up here drilling either in Q4 or early Q1 and continue that drilling streak to keep going. Another exciting area for us that came with the Ridgeback acquisition was this Viewfield Bakken play. It's a very new play that's being developed in a different way here in Canada. Everybody's heard about the fracking of wells, or using hydraulic stimulation to get the oil out of this tight rock. What's been happening here is some of our competitors, and notably Crescent Point's been very active in this area, of drilling up to 6 or even 8 different horizontal wells out of one vertical well bore. And so what this is it really opens up the surface area underground to allow for drainage of these tighter and very light oil deposits. And so we'll be drilling this here into here in Q4, where we've got a number of these, probably up to 3 different wells that we would do, either 6 to 8 horizontal wells out of these things. They're called open hole multi-leg development play. And what this does is keeps the cost down. You don't have to do the hydraulic stimulation. And then on top of that, it's once you're on the drill bit and drilling, and actually adding the extra legs doesn't add a lot of cost to these wells. So we look forward to giving out some results to our shareholders as we undertake this project here in Q4. It's pretty exciting for us. And now into Alberta. We have one drill rig going full-time in Saskatchewan. The other one's going full-time in Alberta, and it's been mostly focused so far on our Cardium assets. On the Lochend side, that's the map on the right side of the slide here, we had 3 wells that went down. One of them was over 3 miles horizontal length. I think it was the 3rd longest horizontal well in the Cardium drilled to date. So what we've been able to do is, since we have so much land in this area, we can really lower the costs, do extended reach horizontal drilling, and open up a lot of the underground deposit and reservoir to each of these wells. So all 3 of these wells were drilled with excellent geological success, grabbed a lot of good rock, and now all 3 are in production here. So we'll have some results on those shortly, but those are three great wells. And then within the West Pembina area, we'll be drilling up here into the year end, adding probably another few locations. And so this is a great asset for us, very similar to the drilling that we do in the Viking in terms of horizontal and hydraulic stimulation. So this is going to be a an area where we have over 130 booked locations. So this will be something where we have a deep inventory, and we'll be at this for many years developing this property. So we did put out some drill results here so far. We have about 18 wells that we've have the data on. I would say in total, we're above type curve on all of these wells, starting with the Oxbow wells and our Viking wells in Q1. We're roughly about 37% above where our guidance or our type curve is. So great initial results. We've got a lot more development capital to be invested this year. We did about $33 million of capital investment in the first half of the year. You'll recall that for the first half of the year, oil averaged the WTI benchmark that we look at less than $75 US per barrel. So a little bit weaker. And now that we're back into the $90 area for WTI, well, we're ramping up our drilling, investing more capital, and bringing on more production. So with this back weighting of capital into Q4, we expect to have a very nice exit rate for this year, and it'll set us up nicely for, another tick up we're looking for in Q1 of next year. So it'll set us up nicely for 2024. We updated our guidance. We pulled back a little bit on our capital spending in the first half of the year. There's a couple of moments where the oil was trading into the $60 range, and for us looking to get the best return on our investment, we decided to pull back a little bit on the drilling program. But now that oil prices are back strong, as a small responsive company, we're back at the drill bit, and we got both rigs going. Probably add a third rig here shortly, just to ramp up production for year end. So we're looking for roughly $430 million EBITDA out of the field. It's probably a decent level to look for going forward on a pre-hedge basis, and on post-hedging, about $375 million EBITDA. That puts us at roughly about 2 times EV/EBITDA on our 2023 basis with our current share price. We're looking forward into 2024 now. Most of the research analysts have moved onto that in terms of their setting their target prices. I'll touch on that briefly. Canaccord Genuity has recently put Saturn Oil as its top pick. I'm quite humbled by that accolade. So within their oil and gas universe, we're their top pick, and they expect probably, from their target price, just over 100% rate of return, and they have a $5.75 target price. And based on what the analysts are seeing in terms of our 2024 debt adjusted cash flow, or very similar metric to EV/EBITDA, we're trading at just below 2 times. That puts us kind of at the lower end of the bunch, but certainly, as Canada's fastest growing oil company, I think that we've got some time to let the stock price catch up here. And if anybody's interested in any of this research, certainly you can reach me at ksmith@saturnoil.com. I'll end off, of course, with our ESG message. We put out our inaugural ESG report this year, something that as a growing company we take very serious. We've added on a number of different programs to reduce our greenhouse gas emission, and these are things that we think that we can take from, reduce our emissions year over year, somewhere from 30 to 40%. And we don't produce a lot of greenhouse gas to start with. Most of our pumps are on power. We don't have a lot of consumption or burning of natural gas. And so for us, it's still important, and it's important for everybody to kind of reduce that footprint. Again, my email address, ksmith@saturnoil.com, or I also check the info@saturnoil.com. If you have any questions or you want to see some of that research, I'd be happy to pass it on. And if you have any questions now, I'm happy to entertain those as well.
Thank you, Kevin. There are already a couple of questions in the chat. So first of all, what did the management learn from the adjusted targets that you made to the current guidance?
Well, one of the big things is we are susceptible to the price of oil. When we first came out in January, we put out our guidance at $80. Of course, it averaged less than $75 for the first half of the year, and like a couple times it was trading in the 60s. So, I mean, we will always have to slow down our drill program if prices go lower. That's just that's a responsible thing to do. It's also prudent as oil prices go up that we'll increase our spending. And really, what we're trying to get is the fastest payback on our investment as possible. We lost about 2,000 plus BOE a day in our Q2 production from the wildfires, and that's something just kind of out of our control as well. So, I mean, I think we do a pretty good job of forecasting. We difficult time forecasting oil prices. I think that they're very strong for the next long while. Certainly, Saudi Arabia and Russia have stuck with their voluntary cuts. So I think oil prices will be strong for some time, but they always come with some ups and downs too.
Okay. And the follow-up question is, will the outlook or the guidance for 2024 be more conservative, or what are you planning to do next year?
Yeah, we'll come probably when I release our Q3 results in November, sometime around at the end of the year, we'll come up with our 2024 guidance. We have a pretty good indication from what analysts are saying about us and their expectations going forward. But if oil prices hang around here, we'll probably be doing north of $100 million of EBITDA on a quarterly basis. So we try to do our best job to forecast out. We do have a certain amount, probably close to 60% of our oil and liquids production is hedged. So we do have some visibility with that, but that leaves a lot of oil production that gets caught with the spot price on marketing that product. And so, right now it's fantastic. It's well above where we've been guiding for. So we should have a pretty strong Q4 if these prices hold up.
And how much capital will you need next year to keep up the 20,000 barrels of production?
Yeah, the capital we see is probably around that $150–160 million. Would be able to keep that production flat for perpetuity, anyways, until such time as oil prices go. If there's a falter in that, or certainly we have a number of locations that keep us going for the next decade and a half, and we're always adding new locations as well. The geologists are always hard at work finding new drill locations.
And is there more merchant acquisition planned?
Valuations continue to be very low in the oil and gas market here, which is great for us because when we make an acquisition, we can get it at a very low price and have that acquisition pay off its own financing for it. So we are looking at some ideas. We're always looking at opportunities to kind of fill in around where our production area is, but there's nothing imminent that I'm aware of. And if we continue to find something that's very accretive for our shareholders, we'll take a good look at it.
And can you provide details on Saturn's plan for drilling in the fourth quarter, especially the multi-well conventional Bracken well?
Yeah, so we'll drill 3 or 4 of those of Bakken conventional wells. Those are the open hole multi-leg wells. We've got some of the best land in that area for that play. It was a play that was developed. It was kind of a drilling technique that was just really caught attention to the industry last year, and it was done more in the Clearwater area of Alberta. But this drilling technique, which reduces drilling costs, increases hopefully expected ultimate recovery rates, and really bolsters the return of our drilling. So we will be doing that here in the fourth quarter, and we're looking forward to seeing if we can replicate some of the great results we're seeing in the industry. And we certainly have some of the best land in that area for this type of development.
And what are the expectations for the initial production numbers from Montney and Cardium in Alberta?
Well, for the Cardium wells, I mean, there's a few different profiles. Some of them are a mile long, some of them are 3 miles long. So there's some different expectations, but you know, anywhere from you know, 150 to north of 200 barrels a day for an initial production rate is a good win for us, especially in these oil prices. So we're monitoring these wells now, and when we have 30 days of data, we look forward to updating our shareholders with the facts.
And how does Saturn Oil and Gas plan to maximize free fund flow and manage debt repayments?
So debt repayments, you know, is top priority. 60% of our cash flow goes towards repaying that debt, and that comes at the expense. I mean, if we spent 100% of our cash flows on drilling, we'd be able to expand production quite readily. But we've taken the tack that we can add a lot of shareholder value by tackling this debt load. And so currently we did get a deferral for 2 of our debt payments this year, and that allowed us to put a little more capital towards increasing production to go into next year. And then with that large amount of cash flow coming at us next year, like I said, a majority of that goes towards paying down debt, and the rest to keeping production flat.
Yeah, maybe you can elaborate on that a bit more. So can you explain the significance of the agreement with the lenders to defer principal payments?
Right. So the principal payments right now are at $25 million roughly per month. And then they drop down to somewhere roughly about $14 million, or in that kind of low teens, after Q2 of next year. So until such time, there's some large payments going out. And then, so basically the idea is 50% of the debt gets paid off in the first year, 30% in the second year, and 20% in the third year is the amortization schedule. We're lucky to have a very, I would say, a flexible and understanding lender, because when we got to the end of this year, we certainly could have made those payments, but we saw the opportunity to ramp up our drilling program into this $90 WTI oil environment, and of course they review our drill results with as much scrutiny as anybody, and so they gave us the green light to accelerate capital spending into this year, and those 2 payments that we had will then go out to 2026 and get deferred basically as a bullet payment at the end.
And do you plan any dividends or share buybacks in the future?
We are looking at ways to refinance our debt. It's no doubt that it's a mezzanine style debt, and it comes with a bit of a coupon on it that's kind of in the mid-teens in terms of interest rate. And so it was never meant to be a permanent part of the capital structure, and that's why we're looking to pay it down as quick as possible. But sometime here, you know, probably in the new year, if not a bit sooner, we'd like to be in a position where we can restructure the debt and change the amortization schedule to be something a little less steep and certainly a lower interest rate. And at such times, we're able to lower amortization payments. That big wave of free cash flow, which is probably be north of $200 million on an annualized basis, is then available for, you know, potentially increased capital spending, but also for share buybacks, potential dividend. Now, the board doesn't have a mandate yet for a dividend, but seems like a natural alternative to consider with that amount of free cash flow coming out of the company.
Okay. And maybe for a final question, can you talk a bit about the hedges that you have in place?
Yeah, I'm still sharing my screen, so I can flip to this. We do have a slide here. So roughly 56% of our hedges are hedged right back to the Canadian dollar. Often what we've really enjoyed here, like most Canadian oil and gas producers, is the strength of the US dollar. Our cost base is in Canadian dollars, but we basically get paid in US dollars. And so the strengthening of the US dollars has ridden, you know, that tide has, raised all the boats here in Calgary in terms of cash flow. We've locked in a lot of those gains now back to the Canadian dollar. About 61% of our oil and liquids production is hedged for the fourth quarter of this year. That's about 13,324 barrels on a daily basis. And so we have some mostly swaps in place. Some of them are collars. And so anytime oil falls below basically $70, our hedge book starts to make money. Anytime oil is above $73, I'm not talking about Q4 here, our hedge book, we lose some money. Now, mind you, nothing makes us happier than losing money on the hedge book, which means that the rest of the production that we have is receiving high spot dollars. And in general, the amount of hedges, they're dropping off every month, so that year over year, the amount of oil that's hedged comes down. And certainly if we keep production flat or even in a position to increase production, then as a percentage wise, that'll come down as well. But as long as we have this debt in place, and we're paying down that very quickly too, so as the debt comes down, the need for hedging comes down as well.
Good. Excellent. Thank you very much, Kevin.